Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler. Talk money and investing. So, of course, that's what we'll start the show with, is talking about investing. You know, just some of the things going on around the world, TV, things that are happening out there that you might see and wonder a little bit about. And get a different perspective, because so often the things that we see in the news, the media, and TV, just very, very misleading. So, one of the things that came up this week, Scott up in the Goodlettsville office actually walked in and said, "Hey, did you see this?" And I'm like, you know me, I don't watch TV. But, you know, you guys watch it, and it's super helpful that you do, because I just miss a lot of stuff, because running 300 miles per hour all the time. But there was a thing on Shark Tank. And if you're not familiar with Shark Tank, it's a program out there for people that are trying to get investors for their businesses. They have these business ideas and they run it by these entrepreneurs that are on the TV program, and they decide whether they're going to invest in it. They're going to give them a stake in their company and get help. You know, building the company is the idea behind it. I don't fully know all of the way it works because I just don't watch TV. But there was this thing that was done recently, and they were talking about an investing type of a platform. And I thought I would comment on it because I thought that it is so instructive. I used it in a workshop this week, and it was a workshop on, you know, just how our brains, our stinking thinking gets us into so much trouble when it comes to investing and the mistakes that people make. And this is a case in point. This is a really good example of mistakes that people make. So, you know, just check this out, and I'll comment. I'll stop and comment as I go through.
First in the tank is a way to invest like the rich and famous.
Now, number one, the rich and famous. If we could just invest like the rich people do, we would be successful. And the question you have to ask yourself is, how do the rich people get rich? I mean, that would be, you know, just a simple question. How do they get there? And is it through their investing prowess? And I would submit, no, it's not. If you look at the research on wealthy people, they just don't do it very well. They don't invest very well. In fact, there was a Fortune 400 book. It was on, and I've talked about this before, but it was on wealthy people and what percentage of them, the growth in their wealth versus just investment markets. And it was pretty abysmally bad, the results that they had gotten compared to in the growth of their wealth. And you would think that they would have access to the best information to grow their wealth at a faster pace, but it just wasn't the case. So they have these three young ladies.
I'm Nikki.
I'm Lucy.
And I'm Victoria.
And we're from San Francisco, California, where the rent is high and so are our ambitions. We're seeking to...
Isn't that cute? So they get three young ladies that are coming up there, and rent is high, and so are our ambitions. And we're going to talk about our business model here. And here it goes.
$150,000 for 2.5% equity in our company, Parrot Finance.
Sharks, let's talk about investing. Right now, if you want access to the best investment strategies, you need to be rich. Like send a pop star into outer space rich.
That's right. Wall Street is a gated community.
So they're making it's Wall Street is rigged. It's a gated community. You can't do it. And the point that I make quite often when I'm speaking in front of groups is that, you know, if you look at the wealthiest people in the world, what do they have in common? They own companies. But they didn't get rich through investing. It was through building their companies. And there's a fine line between those two things. It's a big difference if you own a company and you happen to own it because you own the stock, and you have part ownership in the company, you own shares of it, or you have a mutual fund that owns shares of it. There's a big difference between that and being in the company and actually building the company and owning it in that particular way. So we look at these two different things and say, well, they seem similar, but they're very, very different when it really gets down to it. And they're saying you got to be really rich in order to succeed on Wall Street. And the point that I've made for many years, for 25 years on this show, is no, that's not the case at all. I have a video on my website. It's entitled, "We Should Be Tripping Over Wall Street Millionaires." And it's all about market returns versus investor returns and what is going on. What are people missing? But anyway, we'll keep going.
Rest of us are stuck outside, shaking the fence like, please, sir, may I have a diversified portfolio?
Yeah, so they're mocking diversification, number one. And well, that won the Nobel Prize in economics and how to diversify. How do you measure risk and how do you measure difference in returns between various asset categories? It's correlations. I use bathing suit sales versus winter coat sales. The idea that they don't move together historically because, people have more demand for bathing suits in the summer and winter coats in the winter, right? Same thing with markets. You'll find that in various periods of time, bigger companies just do better than small companies in some periods of time when economy of scale is a big deal. Being big is good. And sometimes smaller companies might do well when maybe it's good to be able to move quickly and you're smaller and you can do that. Or you can have situations where big companies they get overbloated in the late 90s and, they come crumbling down and have 12 years of no returns, where small companies do phenomenally well over that period of time. There's just dissimilar price movement. So diversification, they're mocking and say, oh, we're just left on the outside. Just have this stupid little diversification. And, the point I jokingly make a lot of times with people is, say, if you look at the number of people in the 70s that had let's say they had 100,000, you'd be surprised how few of them actually had 50 to 60 million today. And I use that as an example as that's market returns historically. So to mock that and say, oh my goodness, and the professional managers, well, I'll get to that in a second. We'll come back to that. But anyway.
Meanwhile, the 1% are printing money and we're stuck with these savings account collecting dust. And that's why we created Parrot Finance, an investing platform that lets everyday people mimic top-tier professional investors like hedge funds, insider CEOs, and politicians. Because for decades, only the wealthy had access to these investing strategies.
And you look at hedge funds and you say, well, how have hedge funds done? More on that in a second. But let me hit the second point that they made, that top CEOs. That you can get information on what top CEOs are doing in their companies any day that you want to. That information is out there. Because it tends to be dated because after they buy their own stock or they sell their own stock, and of course you have restrictions on that. So typically you're going to have restrictions where they have to wait certain periods of time before they can do any of these transactions. But that information's that information has been out there for years. And because that information is out there, it's part of the information that people use to buy or sell. So it gets built into stock prices immediately as soon as it's out there. So are these young ladies going to get that information faster than anybody else? No, the answer is no, they're not going to, number one. Number two, there have been pretty interesting studies done on CEOs and insiders in companies trading their own stock versus how the market is done, and they're not that great of it. And you would think that they would have it down. But the thing is, they know, and they know information. They can't trade on inside information, or they end up decorating the jail cell. Martha Stewart. But you can't trade on the information if it's not public information. And so if you look at how they've done, it hasn't been that great of a ride for people that are insiders in companies.
Now you do too.
Here's how it works. Connect your brokerage account, discover and subscribe to high-performing portfolios with proven returns, and view.
So we're going to subscribe to portfolios with proven returns. When were the returns proven, or when were they good? In the past. So what is the golden rule of investing? Buy when prices are low and sell when they're high. So if I have something that's done well in the past, what am I often doing? I'm buying after it's done well. And this is the way Wall Street has marketed investments forever. You know, you look back at how mutual funds have always been marketed. They've been marketed based on, star ratings is one of the things, or past performance. You'll see ads in magazines and look at you hear these ads about the big mutual fund company that says the percentage of their bond funds that beat their peers. And you hear, this is what our track records have been 3, 5, 10 years. And the problem is that is past performance. And they literally in the prospectuses has to say past performance is no guarantee of future returns. And I would even go further to say that it's actually, if you look at some of the research, past performance tells you nothing. Many times the past performance being good actually leads to bad performance in the future. It's just the opposite of what people would think. They think that past performance is going to give them some kind of an idea of how something is going to do in the future, and it just is not the case.
Exclusive investment activity. So when Mr. Wonderful buys a stock, you get a...
Now, he's one of the guys on the show, so they're saying when he buys a stock, we're going to let you know about that.
Alerted and can choose to mimic that trade.
Ooh, wow. We're going to alert you. Now, who would be excited about that? Well, Mr. Wonderful would be excited about that because if he buys a stock, guess what he wants you to do? He would love for you to buy it because what that does is create more demand for his stock and drive the price up of the company that he just bought. And he can make even more money. So it might be really nice for somebody like that, but is it good for the buyer? And the answer is probably not.
It immediately goes into your connected brokerage account. It's that simple.
The rich keep getting richer,
and you don't see this visual because you don't have the video in front of you, but as soon as you buy the stock, guess what jumps all over the screen? Confetti, which is the idea of playing with your emotions and playing with your mind to create some kind of a dopamine hit. Hey, you just did something great. You just did something wonderful by buying that. And that gets people to become addicted to this type of activity.
let you in on their secrets. Now you can have your own mini Mr. Wonderful in your pocket. Only less grumpy. We partner up with all the major North American brokerages to make it seamless and secure. Because smart investing shouldn't be just for the ultra rich.
So sharks, who's ready to ruffle some feathers and parrot the pros with Parrot Finance?
Wow.
Oh, geez. Oh, my goodness.
Oh my.
So they got this parrot, the parrot comes out and it's, the parrot comes out and it's throwing money all over the place. And it's just, one after another. And I'll tell you, these types of things make me crazy. But what I'm going to do, I'm going to take a quick break because I want to find a segment here on the break and then play it right when I come back because somebody asks a really critical question on the show. Literally, and I know you got to hear the answer. You have got to hear the answer. So I'll be back right after this. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. So they have this program out there. It's called Shark Tank, and these people come in with their entrepreneurial ideas. And in this particular case, they've got a program, an app that you get that, It will hook up with all these big major brokerage firms. And what it does is it helps you take what the rich and famous are investing in, or what successful, quote unquote, investors are investing in, and allows you to know what they're doing so that you can mimic their trades so that you can become wealthy as well. That, if you're on the outside looking in and going, man, Wall Street's a gated community, as they put it, and you can't get in, and all you're using is, just diversification, or, quite frankly, a lot of people will resonate with this because they are getting bad results in investing in markets. And that I'll be the first person to tell you that is what I've been talking about on this show for 25 years, is that most investors are getting their information from who? People selling investments. Mutual fund companies, insurance companies, investment advisors who work for those companies, those investment companies, those capital management companies, and so on and so forth. And what they'll do is they just parrot whatever their employer tells them. And then quite often what goes by the wayside is the academic research on investing, because it's boring. A lot of it is not that exciting. It doesn't feel insightful. You feel like your job as the investment advisor is to figure out what is going to be the next hot thing, or what's the area of the market that's going to do well based on what's happening in Iran, or what's happening in Russia, or what's happening in Ukraine, what's going on with China, what's happening in Washington, D.C. You feel that is what investment advice really is. So hence what happens is, and then it's the other part of it is the ego aspect of things. Where, it's also, I have to be able to somehow make moves that are intuitive based on what's happening in these various areas around the world, or in markets, or different types of companies that are likely to benefit. And I've talked about this before, but you have people that are Nobel Prize winning economists. I mean, smart people that have taught, this is something that you shouldn't be doing. And yet what they do is just that themselves. One of them I actually talked about invested and said, we're loading up heavily on China. And you go, wait a minute, professor, you said that that's a stupid thing to do. You don't go and time the market and tactical asset allocation, use that to try to figure out how to get better returns by moving more money to China, because you're basically making the assumption that China is getting ready to take off, and it's getting to, go over the moon. It's going to do really, really well. And when in reality, everybody knows what you do. And then there was another professor, sharp guy. I mean, this guy, you ask him what he thinks about investment theory and how you should actually approach the investing process. It was totally different than what he actually did, which was investing in companies that were around when, New Orleans, and there was the hurricane coming on shore in New Orleans. And he started investing in companies that were supposedly going to benefit from a hurricane coming onshore in Louisiana. And, it's like, well, wait a minute. Those companies already went up in value because everybody else knew that a hurricane was coming onshore in Louisiana. You didn't know anything that everybody else didn't know. But it was just almost like couldn't stop himself from trying to do that. I'm not going to name names for, benefit the person, because, no sense in picking on individual people. But I'm just making the point that we're human, and humans make mistakes like this all the time. So one of the things that they talked about is that, well, what you ought to do is we want to invest like the rich do. We want to watch Mr. Wonderful in his portfolio. What is he buying right now? And like I said, he would love it if you mimicked what he did, because you drive the price up. Then they talk about hedge fund managers. The idea of the hedge fund is they can go anywhere. They can do anything. They can, move in and out of different markets. They can actually invest in options contracts and currencies, and they can short stocks, and they can buy them long, and they can try to manage money in a way that would help them get higher returns, because they have the flexibility to do that. Now, they are limited to accredited investors, wealthy people, because as I like to jokingly say, wealthy investors are basically that group of people that the government says, hey, you can lose money. It doesn't matter. You got enough money, you can lose it. You're not going to run out. So yeah, go ahead and do whatever you want to do. Take whatever risks you want to take. So an accredited investor, there are certain limitations on what the general public can invest in and strategies and things that they can do. But accredited investors, because they're wealthy enough, can do a lot of things that you and I can't do, or, a lot of us can't do. But, the reality of it is it's just, it sounds good on the surface. But anyway, there was a question that was asked here regarding that. And I love the answer that the young lady gave. You'll see why.
For $1 million in the next 12 months.
Warren Buffett many, many years ago made a bet that if you invested in an index, you would outperform all these hedge fund managers. And nobody was able to actually beat a standard passive index. So why are you so confident that this is a better opportunity than just buying an index?
So these funds kind of offer diversification, risk hedging, and then in addition to that, there's just different ranges of investments that they can focus on. So I think it gives people more personality into their investments.
I don't think...
Okay, so there's your answer. Now, number one, he's talking about indexing. And, I've talked about indexing here. The idea of an index, you buy the S&P 500. It's just you're owning the 500 biggest companies in the United States, roughly. The problem that, with that, when you deal with various areas of the market, like small companies and value companies, you're overweighting bigger companies. Historically, it hurts returns because smaller companies tend to do better. If you're overweighting big companies, there's a problem there. They tend to be very inexpensive on the surface, but return-wise can be hurt because of this. And I've talked about that many times, done a lot of workshops on that, taught a lot done a lot of video teaching on that and here on the radio show. But the idea with just plain indexing, it does typically do better than these professional active managers. And that's why people are familiar with the process of indexing. And he's just kind of throwing a little spit in their soup right here by basically saying, hey, look, Warren Buffett bet these people. And in a way, Warren Buffett got a little bit lucky. Let me just talk about this just for a quick second, because he actually made the bet. And it happened to be the time going forward, the S&P 500 was one of the top areas of the market, which is what, Warren Buffett often talks about. So, and you can have periods of time, a 20-year period, in the 1960s through early 1980s, and then you have a 12-year period, and from 2000 to 2012, where the S&P has no return whatsoever. But if you look at most of the data, if you look at, Warren Buffett was right on. If you look at the long run, and those are just 2 short periods of time, and it was a short-term bet. But if you look at the long run, he's exactly right. I mean, the data on hedge funds is really abysmal. It's bad. And people think it's good because of something called reporting bias. You'll have a hedge fund will only report their returns if they're good. Well, it'd be like, teacher being able to only report their students that have A's. Make him look like a better teacher. So it's a really bad criteria, number one. But it's just so funny. What does she say? Oh, they don't have personality. Bingo. What are we looking at there? We're looking at emotion driving the bus. I want to have personality in my portfolio. That's what I'm looking for. That seems like a kind of a crazy criteria for investing. But, that's literally all they had right there. So, there's a lot of times we see this kind of stuff, and it seems to make sense. Follow the rich. But I'm telling you, not such a great idea. Really good for people that own the stocks if you're announcing, hey, this person just bought this company, but not necessarily great for the end investor.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.